The Closing Marubozu is a candlestick pattern that signals the strength of the current trend in the market. Picture a candle with a long body and no wicks or shadows extending from the top or bottom. This indicates that the opening price was either the highest or lowest point of the session, and the closing price was at the extreme opposite end. When a closing Marubozu appears in a chart, it tells us that buyers or sellers were in complete control during the entire trading session. Mastery of the market with the closing Marubozu involves understanding its implications for future price movements. If the closing Marubozu is bullish, with no shadow at the lower end, it suggests a strong buying pressure and could indicate the start of a continuing uptrend. Conversely, a bearish closing Marubozu with no shadow at the upper end signals strong selling pressure, potentially heralding a downtrend. Incorporating the closing Marubozu into an investment strategy involves recognizing these patterns early to make informed decisions about entering or exiting trades. For instance, spotting a bullish closing Marubozu might be a good time to buy, anticipating further price increases. On the other hand, discovering a bearish closing Marubozu could be a sign to sell before prices fall further. Understanding the closing Marubozu and its implications requires practice and experience. However, once mastered, it is a powerful tool that can significantly enhance an investor's ability to predict market movements and make profitable decisions. In the exploration of technical analysis within the financial markets, the double doji presents a fascinating subject. The term itself refers to the occurrence of two adjacent doji candles on a chart. A doji candle is characterized by its cross-like shape, indicating that the opening and closing prices for that time period are virtually identical. This shape visually captures a moment of equilibrium or indecision in the market, where the forces of supply and demand are balanced. The phenomenon of a double doji amplifies this sentiment of indecision. When traders encounter two consecutive doji candles, it suggests an even more pronounced period of uncertainty. Financial markets thrive on the sentiments and subsequent actions of traders and investors. In this context, the double doji often serves as a signal to market participants, suggesting that a significant move could be on the horizon. The direction of this move, however, remains uncertain until further market action provides clarity. This uncertainty is not to be viewed purely as a hurdle, but rather as a pivotal moment that can precede significant market moves. Traders may look to additional indicators and market context to decipher potential outcomes and position themselves accordingly. The enigma of the double doji, as it is aptly termed, thus holds the potential to inform critical trading decisions in the face of market indecision. Identifying a double doji pattern involves spotting two adjacent doji candles on a trading chart. A doji candle occurs when a security's open and close prices are virtually the same, translating to a minimal body. This indicates equilibrium between supply and demand, suggesting indecision among traders. When two such candles appear side by side, it highlights extreme indecision in the market. The key to recognizing this pattern lies in understanding the visual representation of doji candles. These are represented by lines rather than the thicker bodies seen in other candle types. The double doji thus appears as two thin lines positioned closely together, with small or no bodies and shadows extending both above and below, illustrating the opening and closing prices are nearly identical for two consecutive trading sessions. To accurately identify a double doji, one should look for two adjacent candlesticks with almost no body, indicating the opening and closing prices are almost the same. Lines or shadows that may extend above and below the candles, showing the trading range during the sessions. The appearance of a double doji signals extreme market indecision. Traders often wait for further confirmation before making trade decisions, as this pattern suggests a potential turning point or continuation of the current trend, depending on the market context and subsequent trading periods. A double doji is a pattern seen in financial charts composed of two adjacent doji candles, which are characterized by their slender bodies. This pattern signals a high level of indecision amongst market participants. The doji candle appears when the opening and closing prices of an asset are virtually equal, resulting in a narrow line. When two of these candles appear side by side, it accentuates the uncertainty, suggesting that neither buyers nor sellers could gain a clear advantage during the respective periods. Deciphering market sentiment involves understanding the psychological state of the market participants, which is reflected in the price movements of assets. The appearance of the double doji pattern in a chart is a critical signal for traders. It indicates that a period of equilibrium is reached where the forces of supply and demand are balanced, but this equilibrium is fragile and may precede a significant price movement once market sentiment shifts and one side overpowers the other. Traders and analysts closely monitor such patterns as they can foretell potential market turns or continuation of the current trend, depending on the context in which they appear. For example, if a double doji appears in a predominantly bullish market, it may suggest that the upward momentum is losing strength and could possibly reverse. Conversely, in a bearish market, it could indicate that selling pressure is waning, potentially leading to a reversal to the upside. Understanding the conditions that give rise to such patterns and their implications allows traders to make more informed decisions, considering the psychological nuances and underlying sentiment driving market dynamics. The double doji pattern, consisting of two adjacent doji candles, signals a state of extreme indecision in the market. A doji candle occurs when the opening and closing prices are virtually identical, producing a candlestick that looks like a cross or plus sign. The presence of not one, but two doji candles back to back amplifies the indecision, indicating that neither buyers nor sellers could gain the upper hand during these trading sessions. In the context of the pattern's nature as a prelude to a shift, the double doji serves as a critical juncture. It suggests that the market's equilibrium is delicate, and any significant news or external stimulus could tip the balance, leading to a new direction for the price movement. This potential shift makes it a moment ripe for traders to pay close attention, as the subsequent price action can offer valuable insights into the market's next phase. Understanding the double doji and its implications requires investors to observe the market keenly and consider it in conjunction with other technical indicators and market news. This pattern alone does not predict the direction of the shift, but signals that a significant move may be on the horizon, emphasizing the importance of preparation and further analysis to anticipate the market's next move. When we talk about a double doji, we are referring to a situation in technical analysis where two doji candles appear back to back on a price chart. A doji candle is a trading pattern that indicates a level of indecision among investors in the market. This pattern is characterized by its unique shape. The open and close prices are almost the same, leading to a slender body. The presence of two doji candles side by side amplifies the signal of indecision. Confirming the signal of a double doji involves looking for additional cues in subsequent candle formations or using other technical analysis tools. For instance, if the market begins to move significantly in one direction following the double doji, this movement could confirm the market's direction and suggest an upcoming trend. Traders often wait for this confirmation before making investment decisions, as acting on the double doji alone could be premature given its nature of signaling indecision. In simpler terms, think of a double doji as a moment of pause in the market where buyers and sellers are evenly matched, leading to uncertainty. Confirmation is like waiting to see which way the wind will blow hardest, indicating a more clear direction in the market. This allows investors to make more informed decisions with an understanding of the potential trend direction. The reliability of the signal given by two adjacent doji candles, known as a double doji, in indicating extreme indecision in the market, is considered with caution. A doji candle occurs when the opening and closing prices are nearly the same, symbolizing equilibrium between buyers and sellers, and therefore uncertainty. When two of these candles appear side by side, it underscores a heightened level of indecision. To understand the significance of this pattern, it is essential to consider the context in which it appears. For instance, when a double doji emerges after a strong price movement, either upwards or downwards, it may signal that the current trend is losing momentum and a potential reversal or significant price movement could be imminent. However, while the double doji can serve as a warning signal for investors and traders about potential volatility, its predictive reliability is not absolute. Market conditions, volume of trade, and subsequent candle formations should be analyzed to make more informed decisions. Essentially, the double doji highlights a moment of hesitation in the market, prompting observers to pay closer attention to subsequent developments for clearer direction. The double doji pattern represents a situation in the financial markets where two consecutive doji candles appear. A doji candle is a specific type of candlestick on a chart that signifies a period of time in which the opening and closing prices of an asset are virtually the same. The appearance of a double doji indicates a high level of indecision among traders and investors about the future direction of the market. This indecision suggests that both buyers and sellers are unable to assert control, leading to a balance or stalemate situation. When considering the synergy with technical analysis tools, the double doji pattern becomes even more powerful. Technical analysis involves the use of charts, patterns, and various indicators to predict future price movements based on historical data. By combining the double doji pattern with other technical analysis tools such as support and resistance levels, moving averages, or momentum indicators, traders can gain a more comprehensive view of the market. For instance, if a double doji forms near a key support level, it might suggest that the support level is strong and could lead to a potential upward reversal in price. Alternatively, the occurrence of this pattern near a resistance level might indicate that the resistance is holding, possibly leading to a downturn in price. In essence, the double doji pattern signals a pause in the market's trend, offering traders a moment of reflection to consider their next moves. When used in conjunction with other technical analysis tools, it can provide valuable insights, helping traders to make more informed decisions about when to enter or exit trades. A double doji is a term used in trading that refers to a situation where two adjacent candlestick patterns, both are dojis, appear on a chart. A doji is a specific candlestick shape that indicates a level of indecision in the market, where the opening and closing prices are equal or very close to each other, making the candle appear as a cross or plus sign. The appearance of one doji can signal uncertainty, but when two dojis occur back to back, it strongly suggests that there is extreme indecision among traders about the asset's value. When navigating the pitfalls associated with interpreting double dojis, it is crucial to understand that while they signal indecision, they do not necessarily forecast future market direction on their own. Traders often look for additional confirmation through other indicators or subsequent candlestick patterns to gauge potential market movements. Acting solely on the appearance of a double doji without context can lead to premature or misguided trading decisions. It is also important to consider the market conditions or events that might be causing the indecision. External factors such as economic announcements, geopolitical events, or significant changes within the company or sector can influence market sentiment and need to be accounted for before making any trading decisions based on these patterns. In summary, while double dojis can provide valuable insight into market sentiment, using them in conjunction with other analysis tools and considering the broader market context is essential for making informed trading decisions. When two doji candles appear next to each other on a chart, it signals a high level of indecision among traders and investors in the market. This setup, known as a double doji, is an important pattern for traders who use technical analysis to guide their investment decisions. Let us delve into its strategic applications. The appearance of a double doji suggests that neither buyers nor sellers are able to gain control, indicating a potential turning point or a continuation of the current trend based on the context in which it occurs. For traders, this setup requires a closer examination of surrounding market conditions and candlestick patterns. To capitalize on this signal, traders often wait for a subsequent candle that closes outside the range of the doji candles to confirm a new direction. If the following candle breaks above the doji formation, it might suggest a potential upward movement, encouraging a buying strategy. Conversely, if the break is below, it suggests a downward movement, potentially signaling a sell or short position. Furthermore, the strategic application of the double doji pattern also involves considering other technical indicators such as moving averages, support and resistance levels, or momentum indicators to gauge the strength of the potential move. Combining these with the double doji pattern can enhance the reliability of the trading signals and help traders make more informed decisions. In summary, recognizing a double doji setup offers a strategic advantage by highlighting moments of market indecision. By waiting for additional confirmation and employing other technical analysis tools, traders can better navigate the possibilities of a market turning point or the continuation of an existing trend, thus making more calculated and potentially profitable trading decisions. When discussing the concept of the double doji, we are referring to a formation in the world of technical analysis that consists of two adjacent doji candles. This pattern is significant as it signals a state of extreme indecision among traders and investors within a specific period. A doji candle occurs when the opening and closing prices of a financial instrument are virtually equal, rendering the body of the candle very thin, resembling a cross or plus sign. In the context of exploring variations, we delve into how different market conditions or time frames might influence the interpretation of double dojis. For instance, if this pattern occurs after a prolonged uptrend, it may suggest that the upward momentum is losing strength and a reversal or sideways movement could be imminent. Conversely, if the double doji appears following a significant downtrend, it might indicate that selling pressure is dwindling, potentially signaling a reversal to an upward trend. Understanding the significance of the double doji entails recognizing its role as a harbinger of potential change. It underscores the importance of vigilance and further analysis. Traders often look at additional indicators and the broader market context to confirm the potential shift suggested by the double doji. This pattern, by epitomizing the equilibrium between buying and selling forces, calls attention to the nuanced dynamics of market sentiment, making it a valuable tool for those seeking to comprehend and anticipate market movements.